Good afternoon, and welcome to the second installment of Morrison Park Advisors' Frankly Speaking webinar series, Pushing Past Green Bonds, Creating Impact Through Direct ESG Investing. My name is Dave Santangeli, one of the original co-founders of Morrison Park, and I'd like to welcome our two guests, Derek Ballantyne and Harry Balasubramanian. I knew I was going to trip over that, Harry.
Balasubramanian.
There you go. That was my note, was to not screw up your name, and of course I did. But welcome. Derek is one of the pioneers of social impact investing in Canada, and Harry is one of a global thought leader in sustainability and sustainability investments. First, a couple of housekeeping matters on the actual webinar. We plan to go along today for about 45 minutes. We may be able to get to some questions. If you have a question, please enter it into the chat box on your screen. At a minimum, though, we will be responding to questions through the MPA LinkedIn page or through directly to email to you. Most importantly, though, in honor of International Women's Day, pleased to report that almost half of our attendees today are women. Which is a great trend in our industry. A lot more work to do, but really is a great sign. We're very happy with it. The title of our webinar series is Frankly Speaking, and that title is, I believe, particularly appropriate for our subtopic today. We've all seen a cascade of announcements from corporations, banks, governments, describing multiple billions and hundreds of billions of dollars being directed to ESG. The reality is, though, that on the ground, there's a general level of lack of understanding as to what that actually means, and the sorts of questions that I know I get really are kind of crying out for a better understanding as to what this is really all about. And for those of us who've been in the trenches trying to execute on direct impact investments, the reaction to these announcements is, anywhere from sort of a cautious optimism right through to fairly high degree of cynicism as to whether that money is really going to get to the places it needs to get to. So the purpose of today is to shed some light on a couple of specific topics. Firstly, what is the nature of the current practice of a negative screening, which is what the vast majority of ESG investments currently is? What does it do? What does it not do? Secondly, who are the people out there making direct impact investments? What sort of people are they? What are the organizations like, and what makes them tick? And thirdly, what are the obstacles that exist to more direct impact investments? I think our view is that there are a lot of obstacles, and they really have to be eliminated or reduced in order for direct investments to really reach the level that we believe is needed. But before I do that, what I thought I would do is actually throw the floor over to Derek and Harry to talk about their journeys. Each of the three of us came to this topic from radically different places, and it really is interesting. The three of us have ended up on a webinar talking about direct investments. So Derek, why don't you start and just kind of talk about your journey and how you ended up here today.
Yeah, this would, if I'd imagined where I'd be 10 years ago on this webinar and thinking about direct investments, this would not have come to mind. A little bit before that, I was working in affordable housing, managing a large Toronto-based public housing agency. And my journey into this space really started with the realization that we weren't going to really affect much in the way of social improvement or social change without thinking about how to access capital and how to access capital in large quantums to be able to start investment in these spaces. And this is, we did work with Morrison Park at the time in terms of doing one of the first debt placements for social housing and direct debt placements for social housing in Canada. And that really started me on a journey of wanting to investigate more about how we can draw capital into places of real social impact. So I say real social impact because, I will come back to it, I'm sure, but I think there are a lot of ways in which one can talk about social impact, but where it has a real direct impact on the outcomes on people's lives or on communities. I think that's what is the differentiator between sort of investments which may not do any harm or which have some benefits attached to them, but aren't directly purposeful about the space. So that journey took me to, by chance, in a way, inheriting a small community loan fund, which was started a sort of a really interesting piece of work around how to bring capital and allowing nonprofits and charitable organizations to access capital and debt capital, largely unbanked sectors who could not find capital to generate enterprise. And since then have joined forces with a couple of other really smart and dedicated impact investors on a platform called New Market Funds, where we manage community loan funds as well as real estate rental housing investment funds, and really have that platform as a launchpad for other direct social impact investment.
Thanks, Derek. Hari?
Yeah, thanks, Dave. Pleasure to be here. And so my journey is slightly different, although it starts from the impact perspective. And Derek, similar to you, if you asked me 10, 15 years ago if I would be on this webinar, I would have absolutely said no. Frankly, I would have said I wouldn't have been in a room talking with investment bankers at all at that time.
But that's not that short a list, but go ahead.
But that's where the journey has taken us. So my journey began sort of purely in the environmental impact space. So I started my career in tropical marine conservation. I spent my time living on beaches in my 20s in Southeast Asia, the Indian Ocean, Southern Europe, and the Caribbean. And then I moved on to a nonprofit. So I was really fascinated by this notion of environment for environment's sake, but then also environment as it related to communities around the world, the people most closely associated with and affected by environmental damage. So I saw this real interesting space in the nexus between people and the planet, and I thought the way to address it was through philanthropic and public funding. So I worked for a nonprofit for a number of years, one of the largest environmental nonprofits in the world, Conservation International, where I had a pretty expansive role and learned a heck of a lot. So I worked across all of our programs, all of our partners in over 45 countries around the world. Learned a tremendous amount from communities, understood more and more sort of the context people were facing when trying to achieve results for environmental impact and community impact on the ground. But exceedingly got frustrated by the notion that we could save the world with philanthropy and public money alone. See, we were working at a pretty significant scale for the environmental nonprofit world, but in the relative scheme of things, the economy was still trucking along, actively destroying the environment, and we were taking scraps at the end of the table trying to save the world from climate change, biodiversity loss, and these environmental impediments. And I thought we had, interesting people at the table. We had tremendous board members, leaders of corporations, very wealthy families, but they were giving us money rather than changing how they operated in their business. And I thought that the world needed to shift a little bit. We needed access to more capital, and we needed to get away from this notion that we could only benefit people on the planet using philanthropic and public money. So in 2012, I left the nonprofit world, moved back to Canada. I'm in Eastern Canada in Halifax, grew up in New Brunswick, but moved back and really focused on this notion of integrating environmental performance and sustainability into core business and allocations of capital across sectors and across the stack. So really trying to figure out, could we leverage up from pure philanthropy and sinking public funds to return of capital, whether concessionary or purely commercial? And how can we change the narrative from thinking about sustainability as a cost item on a balance sheet in the public sector, private sector, and financial sector to really an investment for future value? Because that's where the world was going in around 2010, and that's where the world continues to go. So how can we use capital for both good and for profit? And to date, through our consulting practice, we've helped influence just north of $3 billion US dollars towards environmental impact. Like I said, across sectors and across the stack, from purely philanthropic to concessionary and blended finance through to purely commercial. And we see a huge opportunity moving forward in aligning more sort of this integration of impact and profit towards direct investments in sustainability.
Thanks, Hari. So our story is a little bit different. As many on the audience may know, that most of the folks at Morrison Park are former Scotiabank people, a good chunk of us anyway. Brent Walker and I left Scotia in 2004 to start Morrison Park. And in 2006, I believe, we were invited to act as financial advisor to Toronto Community Housing as they sought to finance what I believe is one of the most kind of innovative, public-private partnerships, in the impact space that's ever been done, and that was the reconstruction of the Regent Park neighborhood. And Derek is being a little bit modest, and that was really his idea, and he was the driving force behind doing that. So we spent 3 years with TCHC. Ultimately came up with about $850 million out of the total $2 billion capital spend that had to happen with TCHC. And as a former Bay Street person, and I've been working on Bay Street since the late 70s, it was a tremendous eye-opener. It was an opening to a world that I did not know existed. And that is that, there are a literal army of people out there working with mission-driven organizations trying to effectively execute commercial strategies to create a result. And the result is, to Harvey's point, people think of it as, profit or nonprofit. It's just not that way at all. I mean, that's simply a false choice. There are like thousands, hundreds of thousands of people in mission-driven organizations trying to create impact investments. What we found, though, was that they don't have the financing tools, whether it's expertise or access to capital or those sorts of things. So it started us on a journey, which we're still on, which is effectively using our backgrounds to put those tools in the hands of mission-driven organizations. And I'd like to say it was just us being smart. There's probably a little bit of luck involved. It was the work that was available to us because we didn't work at the bank anymore. And entities like that don't get the attention of the banks, or haven't historically. When we look back at our work since 2011, we recently took a look at all of our files, and what we're surprised to find is that actually more than 52% of our work in the last 10 years has been in the ESG space. Most importantly, though, I found it to be, and a lot of our partners at MPA found it to be tremendously personally fulfilling, and it's really some of the work that we're most proud of. So we're really focusing on it, and we're expecting and planning to work with people like Derek and Hari on an ongoing basis to make that a key part of our platform. So we've all come from different backgrounds. Here we are. The first topic I think we should focus on is this whole topic of negative screening, and that is actually the lion's share of what's happening in this space currently. So Hari, maybe I could kick it off to you just to talk about what that means and what it does and what it doesn't do.
Yeah, thanks, Dave. So I think before we talk about negative screens and ESG and sort of the progression of where we're going with impact investing, it's worth a look back and to reiterate a point that you made and that I did earlier. First, looking at sort of what the role of capital is. So historically, we've had this distinction between the role of capital to make money, being profit motivated. So activities are performed in order to generate profit, and that's the conventional sort of marketplace. And if you want to have constructive outcomes for social and environmental results, that's typically been the purview of the nonprofit space. So you're spending money in order to achieve those outcomes, and profit isn't your motivator. And if it happens, it happens. It's not sort of fully aligned. What we're talking about in impact investing is really a dual purpose. So conducting activities in order to generate profit as well as constructive outcomes or impact. And it's really a shift in thinking in terms of how activities in the commercial marketplace are being deployed. So if we think about the transition from that distinction between the conventional marketplace and philanthropy for constructive outcomes into where we're heading today, the progression started with sort of, if we're doing activities to generate profit, should all activities be considered valuable activities to pursue as long as profit is being generated? And historically, that was the case. So we would do anything we could to generate profit. Around the 70s, people started to look at that in a little bit more detail and say, wait a second, if we're supporting activities that are destructive to social and environmental outcomes, that shouldn't be something that we pursue. So the notion of negative screens really formed from that, SRI principles, or socially responsible investing principles, which was basically the notion that not all activities are created equal because some of them are destructive to social outcomes. So we should avoid investing in those types of activities. And that's the basic principle of negative screens. But then people started to say, is there a possibility to do positive outcomes or constructive outcomes alongside profit generating activities? And the notion of that shift really started in the early 2000s, and Kofi Annan brought together 50 odd CEOs from financial institutions around the world in 2004. and basically said, can we shift from this exclusionary principle of not investing in bad things toward investing in things that produce constructive outcomes? And because of the slow moving nature of financial markets, the response was basically, we don't know. So there's not enough data for us to circle around to say that we can invest in things to generate profit and achieve environment, social, and governance outcomes. So as a first step, what we'll do is just start looking and quantifying what that means. So let's kind of categorize what ESG means. Let's get those buckets sort of established and figure out, get the data so that we can start to answer the question of whether we can do these things at the same time. And that's where the last 15 years has really been. So, SRI led to the principles of responsible investing, which a lot of investors came on board and signed the principles. But effectively, the principles don't say invest in constructive outcomes. They say, let's start to document ESG categories and start to collect data and say, do our profit-making activities, and then we'll collect this other information on the side, talk about it, report it, convince other people to collect that data as well. Where we need to get to, though, is how does that information on environment, social, and governance actually contribute materially to financial performance? And how do we integrate the notion of ESG into positive profit outcomes as well? And that's where impact investing needs to go from here.
So Derek, I know for a fact that echoes your experience in the social space.
I think it's true, and I think Harry did a nice gave us a sort of description of the evolution of this ESG in particular. And from the investor side, it was often informed by the ethics of particular investors. So certain philanthropic investors who were in the market had challenges around investing in certain things, so they screened away and they avoided certain pieces. I think what is, and so I actually think, there are a lot of people who are cynical about where ESG has got to, but I think, in fact, if we look back even 5 years, the conversation was nowhere near as sophisticated as it is today. And the true issues that we're trying to get to are starting to surface around what are truly sustainable investments which will have positive benefit for the environment. And in the social space, much more difficult to find those kind of investments that will have support profound change and return a profit based on the risk that anybody is being asked to take. So, a market-based risk, which I think is a more complicated conversation. But I think for the first time, there are products in the market that are available. There are ways of investing in those places now, which were not necessarily available 5 years ago or 4 years ago, even at the level and in the quantum that's available now.
So, the experience that we've had, and again, coming from a completely different lens, is, typical Bay Street types think of, this world in terms of profit or not for profit. And, I personally think that that's actually not helpful. I think it's a kind of an oversimplification of what's really happening here. I personally, and this is a bit of a hobby horse I keep talking about, I think the much better terminology is mission driven. And, we have come across many highly profitable, commercially, competitive entities which have a mission. And, those folks will tell you that being mission driven does not hurt profitability. In fact, it helps it. In all of our work in the housing space, some of it with Derek and some otherwise, if you meet some of these mission driven entities, the level of employee morale is sky high. The level of retention is sky high. These are, many companies would die to have the kind of employee loyalty and motivation that a lot of these mission-driven entities have, because on a day-to-day basis, humans want to pursue a mission. So when I talk about a mission-driven organization, I mean, one of the things, and I don't mean to name names here, but, the Regent Park reconstruction was done with Daniels Corp. And Daniels, I think, Derek, was an excellent partner, and they put a lot of effort and money into Regent Park. Frankly, they didn't have to, because it is actually part of their DNA. And I don't know if you want to comment on that, but I just believe that to talk about people as being nonprofit or profit, it just is a gross oversimplification.
So I think I think you're right. The profit nonprofit is increasingly a false dichotomy, particularly around investment and how you can generate return on capital. I think that and there's more and more evidence that there are opportunities and they don't necessarily fall neatly into one or the other. I mean, to your point about, do mission-driven organizations perform better? The answer is by and large, yes. Everybody's always skeptical of the data, but everybody was skeptical that ESG was somehow going to impede the performance of funds when they're investing in traded securities, and all the evidence finally is in that is not the case. And in fact, through more challenging and volatile economic periods, ESG, very heavily sort of constructed ESG based funds, have done remarkably well compared to the norm. So I think we can set those arguments aside. What I think the distinction really is do you have a solid, well-managed enterprise with a solid business model that's going to yield the returns you have? And you stop thinking about those in terms of profit or non-profit. In some ways, think about capital as being a neutral piece of the equation, which is seeking a return based on the ability of that enterprise to yield it. Whether it's for-profit or non-profit really has no sort of bearing on that equation, if you want. And I think, and what you're discovering is that you have increasingly sophisticated enterprises in that space able to deliver both on the mission part, so both on the sort of outcomes that you're looking for, whether they're in the environmental or social space, and the ability to achieve the returns that you're looking for because there's sort of solid, capable management in place able to do that.
I remember, lots of debate about, management science and quality control 20 years ago, 25 years ago, and complaints that, all these quality control measures were costing all this money and increasing overhead. Well, history has shown that quality control is in fact free, right? Quality control is a profit center. Same as safety, right? If you have better safety measures, you have better employee retention, fewer sick days, and much better productivity, even though you're spending money. My view, being mission driven is exactly the same. It appears as though there's more effort. It appears as though you have to spend money, but the benefit to the organization that I've seen with my own eyes, I think is dramatic. And I know that there are some folks in the audience today who run big companies, and and I know some of those companies, they do have missions, and I think what they would say is that is a big help with respect to attracting and retaining people, and it creates a high level of customer loyalty. So again, it's a bit of a hobby horse that I have, this whole idea of not-for-profit versus profit. I just think it's very damaging, and in fact doesn't really describe what we're talking about. Okay, so we'd like to talk about specifics of impact investing. And I think it might be helpful for perhaps each of Harry and Derek to separately talk about an example that they've been specifically involved in, so that we can bring that to life and talk about the dynamics of how a direct investment worked, what the process was like, just to give a bit of an example, because we've been talking about a lot about this, but let's talk about some specifics. Harry, do you want to start?
Yeah. So I'll talk to you a bit about New Market Funds, our first rental housing fund. It's a closed fund now, but we're just out in the market raising capital again. And it provided commitments to permanently affordable rental housing. So rental housing that would go into the ground, meet affordability criteria that were predetermined. But only be invested post-construction. So we minimize the risk of that capital going into those deals. But that first commitment allowed a whole set of nonprofits to actually leverage up from that first layer of capital in the project, that first commitment, to be able to go out and get financing to build out the rest of the rental housing. Some of it was concessionary capital, some of it, and so it may come in the form of government grant, but a lot of it was simply conventional debt layered in with our piece of equity in that fund. So we've, out of that fund, we'll, on about a $25 million investment, leverage about 1,000 units of permanently affordable rental housing, largely in Vancouver and Toronto. So two of the toughest markets to be able to build this stuff in the current context. So there's an example of a relatively, conventional investment kind of space, an alternatively structured kind of capital capital structure in the deal, returns that are, certainly in line with the risk that anybody's taking these particular deals, with an exit strategy at about the 8-year mark for that investment. So clearly, a big impact on the social side. The only sort of differentiation, I'd say, from many of the investments most would encounter is there's a longer hold period in this kind of investment to get the yield that we're looking for.
Thanks, Derek. Harry, do you want to take a cut?
Sure. I'm going to go back a little bit and talk about sort of how this affected my transition from thinking about philanthropy to return of capital money. So early in my career, I was at Conservation International and really inspired by a mentor of mine, Jennifer Morris, who's now the CEO of the Nature Conservancy. And she had this brainchild in the early part of the 2000s at CI to say, look, we're taking philanthropic money and trying to protect places around the world, but there's a lot of other economic activity that is or could be happening in places adjacent to these parks around the world. Is it possible to use a different form of capital to return money that also delivers on our mission? And the answer was yes, but it's a little bit challenging and it doesn't exist today. So the model that she created was really debt finance for small, medium-sized enterprises that were underserved and underbanked in emerging markets, but we're doing things that were conservation friendly and really supporting the environmental outcomes of our core philanthropic activities. So things like ecotourism or sustainable agriculture in those buffer zones around protected areas, with people and communities, indigenous communities primarily, but communities that didn't have access to commercial finance or debt finance in the markets where they operated in. So they were missing from the banking infrastructure locally. They were dependent on the natural resources. They were at the first point of call in terms of managing any risks to those natural resources, whether it was encroachment or agricultural encroachment or deforestation in other forms. Yet they weren't able to get the financing needed to do activities that were supportive. So she said, well, is it possible to serve this underserved population, provide debt finance in a way that helps them construct business models that are profitable? And then also, given our global reach, we can connect them to supply chains in other parts of the world. That was really born the notion of sustainable harvest finance for conservation friendly activities in and around protected areas. And it wasn't easy. It's hard to find those investable opportunities, and it's hard to build the structures necessary, because in the initial days, farmers were disaggregated. There wasn't a lot of cohesion. Co-ops were still in their early forms and early days. There wasn't any collateral, so we had to think about creative ways to collateralize these loans. But all of that happened, and now harvest finance in emerging markets for sustainable agriculture is a relatively stable asset class. So in our experience in the fund that we had at Conservation International, repayment rates were quite high, above 90%. We were able to pay back our investors at the terms that we were settled on. And the outcomes that were achieved were phenomenal, because it was supporting income generating activities for these communities that were at the front lines of sustainability in emerging markets.
And that's been consistent with our experience. Most of the work that we've ended up doing has, at the end of the day, been really making some pretty traditional plain vanilla tools available to folks who just haven't had access to them, whether that's because of whether that's because of a lack of professional experience, because of the literally physical lack of access, or because the financial world is not paying attention to them. So I would characterize a significant percentage of direct impact investing to be actually relatively simple types of deals brought to people like affordable housing providers or First Nations, or folks in parts of the world that have not been serviced well by commercial organizations. And that's, I would say, the majority of the work that we've done is just putting some pretty plain vanilla tools into the hands of those who need them. Once you do that, they're kind of off to the races. And our experience has been that you're not actually taking an awful lot of commercial risk. Sometimes you're taking less commercial risk because of the nature of the space that you're in. Derek, when you're talking about an affordable housing development, not well understood, but most affordable housing developments have the ability to adjust their programming if they have a cash flow shortfall, and the level of we did some, some research on this, and we were not able to find through any source one example of an affordable housing project or a social housing project where a lender actually lost money. Sure, there have been some workouts, there have been some deferrals, there have been some restructurings, but the system generally solves problems. And so, it really is simple types of deals brought to marginalized or to communities that just don't have access to it, is how I would characterize it. So, the question becomes, how do we put all this money to work, right? There's billions and billions of dollars. Royal Bank announced $500 billion. Brookfield is talking about, a $5 billion fund. How does that money actually get into direct impact investments? And I think that in order for that to happen, there are some kind of ingrained obstacles which are going to have to be dealt with. I know, Derek, when you've been raising money for your funds, you've been out there pounding the pavement for a long time, right? And it's not been easy. It's not been easy to get people to put money into what are pretty attractive investments.
True. One of my colleagues jokes whenever we start a fund, somebody says, "Oh, it'll take us 6 to 9 months," but really what they meant to say is it's going to take us 69 months to raise the capital. It is true. I mean, I think there are a couple of inherent obstacles, and not all. Some of them are the nature of the offer, and some of them are the nature of the capital trying to, or the systems that hold the capital right now. I think, by and large, in Canada, there have not, scaling impact and direct social impact investment has been a challenge. So there are investors that will not come unless we can find opportunity that's of sufficient scale and impact. And to do that, you need a fairly long road to proof of concept and demonstrated management capacity and those sorts of things. And I think in Canada now, there are 3 or 4 platforms or investment managers in this space who have been able to get over that. And I would think ours is one of them. But it takes some time. So it's not been available. It's understandable why some of the larger institutional capital has not been in this space for some period of time. I think the second one is the sort of perceptions of risk, which you spoke to briefly. I mean, in a lot of ways, these kinds of investments inherently are de-risked for a whole series of reasons, but the perception is still one of high risk because it's not a space anybody has been in before, or there's a perception that there's some flaky folks at the other end who are completely mission driven, who are not going to take care of or be true custodians of the capital and be fair and equitable to investors, which I think we've also been able to disprove over time. But that perception exists. I don't really understand this deal. I don't understand what Harry is trying to sell me. I don't understand who these enterprises are. This all feels like risky to me. And then the third one is, often, I mentioned it before, is social impacts. And I think to some degree it would be the same in trying to create deeply and long-term sustainable investment in sort of conservancy and so on, are not short-term investments. They often yield over a longer horizon, which is used often as a rationale for not wanting to come and invest in space. But I often point out to potential investors that they have holds of these natures in their portfolios at all times, is simply because this is one that's not as well known that it becomes an obstacle. But in truth, direct impact investment into these spaces would fit well with almost any portfolio in terms of balance and so on. And for the most part, these kinds of investments are counter-cyclical, have nice balance to other kinds of investments in the portfolio. So you can think about impact as a piece of a portfolio that resolves a number of issues and generates a significant amount of impact. And if that's really your interest, and I think direct impact investing has a place in most portfolios.
Yeah.
Sorry.
Yeah, I would agree with all of that, Derek. And I think the long-term versus short-term is a really critical one. And you're absolutely right that most investors have these types of holes in their portfolios, but they're not looking to impact to fill that gap. 2 things I'd like to raise are one is, in this conversation of impact investing over the last 15 years since I've been around it, we either you start with folks that say impact and profit are not compatible. So you have to get over the hump of understanding that you can integrate those things and provide both. But then what happens, which is really interesting to me, is that people think that you can solve all problems with impact investing and all constructive outcomes can generate a return. And that's not true either. So we have to be really careful about understanding what cash flows look like, what profitability looks like, what impact looks like, and finding those opportunities where all of those things align. You can't just throw commercial capital at everything to generate social and environmental outcomes, because many of those things, as Derek pointed out earlier, don't generate profit, or some of those things don't generate profit. But where we're really focusing in on right now is what are those things that can generate profit and impact? And those things today are underinvested. So how do we find those, and how do we deliver them, and how do we get them capitalized, and how do we get the transactions flowing? That leads to a second point, which is that investors in this space keep coming to me and saying there's no deal flow, there's no pipeline, there's no access to product. And all of that is not true. So it might look different. It might be smaller scale. You might need to aggregate. You might need to look a little bit more carefully. And Derek brought up a really interesting point, and we see this a lot, and we call it lost in translation, in that the deal flow that you're seeing as an investor doesn't look like the deal flow that you've typically seen in a conventional sense, because they're typically run by mission-driven organizations that have typically been financed by philanthropic money with different structures and incentives and a different way of thinking. So when they present their deals, they look like very different things than non-commercial enterprises. But with a slight shift or a rearticulation or a translation, and this is the service that we provide a lot, if you can translate that into terms that investors have seen before, then it becomes very much a source of product and pipeline. So it's a subtle shift just to make the communication sort of resonate more closely across the divide between community and impact and capital, which is where the investors sit. And this lost in translation, I think right now is the primary and most significant hurdle that we need to cross, because deal flow is there, capital is being allocated, and people are saying we want to invest in this space, and the connectivity just isn't happening, because the capital side says there's no deals. That's not true. And the deal side says we don't know how to access capital, because think about a community indigenous community in the Amazon going to Goldman Sachs. How are they going to have that conversation to drive capital towards, even if they're investable opportunities? It's a very challenging conversation.
And I don't even want to talk to Goldman Sachs. So actually, our take on this is very similar, but it's a little more specific. You know, I think you guys both talked about investment time horizons. I think actually what we're really talking about is liquidity, right? There's investors, most investors, you know, high net worth, et cetera, have a small allocation to illiquid investments. And that's actually fairly actively competed for by a variety of different investment styles, investment opportunities. The exceptions are the pension funds. But in this country, the pension funds are tremendously large organizations that only look at very big deals. So, you know, there's a difficulty of getting allocations from bigger investors and from smaller investors to illiquid investments of a certain size. You know, I think the three of us have talked about, you know, two investments that we're working on right now. You know, one of which is, you know, kind of a renewable technology opportunity. Another is you know, waste heat recycling opportunity. Both of which are $10 million investments, scalable over time to 100 million plus, but right now they're $10 million investments. So in the Canadian market, it's hard to get anybody to look at a $10 million investment that isn't really simple, because if it's something you're not familiar with and it's a small deal, people just don't have the time for it. And I would argue that, you know, that impact investments have to be treated as a separate asset class from a couple of different points of view. Firstly, you have to have people, if you're going to deploy, you know, allocations into direct impact investing, you need to have people that you're working with or employ who are actually understand what we're talking about. I mean, you wouldn't put money into a pharmaceutical fund without scientists involved. This is actually the same. I think what really both of you are saying is that this is a separate field. And if you're trying to impose, you know, language and, you know, deal structures onto something in a different field, you have to actually be sensitive to that. So the first obstacle is really expertise and enough people understand exactly how this works. The second is the institutional money management business. I believe, has fallen into a bit of a trap in that it has created um, um, areas of eligible investment which are very narrow, and that has happened because there's been an effort to, improve deal flow, become better experts in what is a very narrow category of investment opportunity. If you're trying to layer the desire to have impact on top of a series of these sharp-sided silos, you're just never going to get anywhere because it's just another layer of investment eligibility requirement on top of an already difficult job. So I believe that these billions of dollars, if they're going to get invested in direct impact investments, have to be put into an investment vehicle that has the right type of capability, and probably acts as a conduit to make it much easier for investors to make those investments. Asking people to all of a sudden jump into the field of making direct investments and impact from a standing start is really very difficult. I actually don't see it as much different than where infrastructure investing was in the late 90s. When we were out there trying to, flog investments in Highway 407 based on a levered pre-tax IRR, people kept asking us questions like, "What's the PE ratio?" Well, it's just a different measure, and it took a decade, and now we have an incredibly sophisticated infrastructure investor universe out there. And I think this is exactly the same. People have to take a look at this as a specific allocation to illiquid investments. And then people like us have to come up with ways to make it easier for capital to slide into those investments.
I think that's right. I think there's an additional piece, though. I think expertise is really important, but I think we've been generating that expertise over the last decade or longer. What I think is really critical at this point is, back to the progression that I talked about from SRI to ESG and integration, is really integration. Because we have the expertise, but it's still fairly siloed in decision-making in institutions, whether it's the corporate sector or financial sector or governments. So you have ESG specialist people that are focused on environmental or social issues, but they get tapped in at points along the chain rather than integrated from beginning to end. And as an asset class, as you described, Dave, and I agree with you fully, if we want to impact as an asset class, you need that expertise integrated at every step along the process and not just bolstered on at the end. Otherwise, we suffer the problem that we have in capital markets and ESG, which is, okay, we'll collect the information and maybe deal with it later. But what we actually need to do is really understand, to my earlier point, that not all constructive outcomes are profitable. We don't even know which ones fully are. But if we can get the data and information on social and environmental impact, those constructive outcomes that tie back to financial materiality, then we have a real powerful tool from the beginning, from sourcing to diligence to everything that we do in deal execution, to really drive performance, both for impact and for profit.
Yeah, I mean, I think, Harry, though, that is critical, and it's sort of critical in informing how this sort of segment of the market evolves. I think, Dave, to your point, it is true. There are very few intermediaries in Canada in this space. So there's very few conduits for capital, and investors are often faced with having to make the decision directly in an area of which they have a great amount of uncertainty, lack of knowledge, and so on. So I do think, if there is some evolution in Canada, it would be around the sort of creating and supporting those robust intermediaries who are able to then manage that capital flow into this space in a way for others, and for investors, create some diversification within the asset class. So.
Well, I mean, I think it just has to happen, and I think it can happen. And it is great that there does seem to be, growing recognition amongst our big institutions that this has to happen. We've just got to make it easier for that money to get into these sorts of investments. That just has to happen, because as it stands right now, my concern is that 2, 3, 4 years down the road, that won't have happened, and this starts to look like a bit of a cynical fad. I think that it is incumbent on people like us to actually make this happen and to come up with easier ways to get that money allocated into these types of investments. So I'm now looking at the clock. We're now at the 45-minute mark, which means we need to wrap this up. I hope this has been interesting and useful to our audience. I know that it's been great for me personally to do this with Hari and Derek. I look forward to continuing to work with you two guys and helping to solve some of these problems. And what I'm hoping is that in the future we can come back again and have a subsequent session on our webinar to talk about some of these things in a bit more detail. So on behalf of MPA, I'd like to thank both Derek and Hari for their attendance today, and all of our audience for tuning in. Happy International Women's Day, and have a great day. Thanks.